Now we'll delve into the transformative discussion in our next speaker session titled Convergence of Digital Payments and Credit, a Catalyst for Economic Growth. In this session, we'll explore the integral role of digital payments and credit integration in driving financial inclusion and accessibility, crucial for tapping into unbanked populations. We'll analyze the substantial economic growth potential that emerges from the seamless blend of digital payments and credit systems. Furthermore, we'll discuss the pivotal role of technological advancement in enabling the merging of payment and credit facilities, marking a significant step forward in our journey towards a more inclusive financial ecosystem. To present the session, let's welcome on stage with a huge round of applause, Ms. Praveena Rai, Chief Operating Officer, NPCI.
Hi, good afternoon, everybody. So, lovely to be here. And I think this is a wonderful day from whatever I've heard of what's happening since morning. And we'll talk of a very interesting and important topic, which is the convergence of credit with digital payments. Now, really, I don't want to talk more about what's happening in the world of digital payments. I think that's said and oversaid to some extent. But if we look at where we are on credit and look at really the kind of penetration for retail credit that is happening globally, we will find that India is one of the grossly underpenetrated markets when it comes to retail credit penetration. Even amongst emerging markets, comparing with markets like Colombia or South Africa, India still tends to have a lot of opportunity space there. So some sort of space on what really is this opportunity and how we can actually map this and size it up. From the population of the country, the number of people who really have a credit score is fairly limited. And even if there is a credit score, there is something called a credit served and credit underserved. So if there is just one sort of a credit instrument or a credit experience, it's really defined as a underscored credit relationship. And if we look at the underserved and the unserved, the percentage of the population is extremely high. So 720 million people who are really still in the underserved. So the concept of really building a credit identity, building a credit score in the country has not really picked up. Our retail credit penetration is quite low if we just go by, let's say, the credit card numbers we have here. We know the latest numbers, about 98 million odd credit cards, but probably many people have multiple cards in their pocket, so still only about 35, 40 million credit card users. So similarly, when we look at various range of credit products like personal loans and so on and so forth, we do find that the penetration tends to leave a lot of scope for growth there. And when we look at context-specific spends, so spends are a day-to-day in nature, but when we go beyond that and look at discretionary spends, look at aspirational spends, and also look at event-based spends. So there is a space where it's tough for somebody to say, hey, I've got an event in the family, I've got this hospital expense coming up, or I have my home renovation, or I just want to buy this really nice television. There are specific programs available, but we don't have a context-based credit that can be offered today in the market. So that's an opportunity space. And the effective use of alternate data. A lot of trial is happening. I think a lot of this credit card penetration, retail credit penetration, the growth that we are seeing is defined by use of alternate data, but there is a lot more opportunity there. Our data models, data scoring is still far behind the level of sophistication one would find in many of the developed markets when it comes to credit scoring. And the size of our informal market, and when we say informal, if you go down the chain, something that's out of the regulated lending system. The regulated lending system is, of course, banks, NBFCs, some element of P2P lending, but this number tends to be very high. And the place for emerging fintech and lenders is still fairly standard in the way it was defined, a couple of decades back. So we have evolved less. Of course, there's been a big BNPL era that we've gone through. But outside of that, it's been fairly limited in that side. And the whole concept of unbundling the form factor. Now, what are really the issues or uncertainties is, of course, the cost of credit and what happens between a lender like a bank or a lender from a non-bank space, and the whole cost of credit, etc., tends to be different. And as retail credit grows, the quality of the credit, the ability to collect, the potential tightening of the credit cycle, these are all larger macroeconomic variables. But of course, if we say there's an opportunity space, we have to keep our eyes on these risks, and that's what our lenders tend to be highly focused on. So moving from here, I thought I'll just jump a little bit to where we are with something that is in play as we speak, and that is really the link of retail credit by way of credit cards to digital payments by way of UPI. So this was really the first step of linking the credit opportunity to a payment opportunity which is already evolved, has grown, and is in a fairly mature phase. So we're talking about, of course, I put very generic numbers here, QR code acceptance in the country, it could be 70, 80 million, whatever, but the fact is we are talking of a big sort of a significant difference. But 4 times the number of transactions and nearly 2 times the spend is what one sees when you look at a portfolio which is operating independently as a card, and a portfolio that is operating with UPI that is actually powering the acceptance. And that's a great story we have here. So a bit of a play, and this is something that is in process. I thought I'll just give you a sense of what this roadmap looks like. The roadmap is really to say that credit on UPI has 2 angles. The ability to link assets that already exist, like a personal loan that's already been issued to a customer. Earlier, this loan would be credited into an account, and then that account would get linked to UPI or may not get linked to UPI. Somebody will just take the cash out and make a payment. Sometimes there is loan that has been disbursed but stands unutilized. So this really provides a great opportunity for high level of utilization and on need basis. So it becomes more efficient for the customer and becomes a large opportunity for the lender as well. And then there is credit line linking. Now, credit line operates a little differently, which means that asset products can get created, which can have a very different structure than what we see today. And what are these variables? The variables that can really open up is that there could be interest-free versus interest-bearing credit. There can be variations in repayment cycles. So the moment we say interest-free, it can be 1 week, 2 weeks, 3 weeks, and so on. Again, it depends on customer profile. It can depend on a variety of parameters. The purpose of the payment, right? We spoke about, is this for, let's say, travel, right? Is this for a holiday? Is it for event? Is it for discretionary expenses? So I think the purpose can be defined more specifically, and programs can be targeted accordingly. And of course, variations on EMI. Today, EMI tends to be a very acquirer, aggregator, point of sale oriented experience. And however, EMI can really open up to be an experience that the consumer has more control over and the issuer has more control over. Limits. So when we talk of limits today we are used to a very one-track manner in which a limit is offered. So a limit is offered, you get a certain disbursement or you get a certain limit that is being provided. And either increasing or decreasing, asking for more or the lender offering more, tends to be a fairly complicated process. And sometimes very disturbing process. I think we all get a lot of calls on that also nowadays. So the whole thing can just move to the digital mode through the mechanisms that we have here, and what sort of security is offered against a credit. So a lot of growth of credit is based on secure lending, but unsecure lending also exists. If you look at the numbers, in fact, loans against fixed deposits or loans against shares, and again, different parts of the country might have a very different element of what sort of security really works. And this really opens up all of those elements that are available. And this is a kind of a roadmap that I thought I'll put up here. So if we look at the whole credit value chain, right from discovery, which means identification of the customer segment, and being able to target and focus the discovery of that customer segment. And I'm sure there's speakers from ONDC here, but they are doing a lot of good work in terms of very targeted discovery, which can come from the consumer side, but there can also be a focus that can come from the lender side. And the whole point of where is this originated? Is it originated separately? So a lender identifies a customer or a customer segment, approves the kind of credit profile they're looking for, and that's the starting point, but it can also get initiated from a point of purchase, right? Which is really where a consumer is also in the right frame of mind and psychologically really looking for the support when they're looking to go and purchase something. And then we come to the opportunities around origination and underwriting. And I think when we look at the whole digital model of onboarding, these are some of the friction points today in terms of the kind of data that is required, in terms of the kind of documentation that is required. And India is, again, one of those markets where we still have to submit pay slips and income tax returns and all of that stuff, right? So if in really evolved scoring models, some of these requirements start going away. And there are mechanisms in the country today where we should be able to take in documents which we are able to access through authenticated and digital modes. The DigiLocker, for example, being one of them. So there are solutions that can start coming together to solve for how the whole process of underwriting and origination can take place, along with digitizing financial assets here. So for example, if deposits are tokenized and these become discoverable on a common platform, then lender A can actually have access to tokenized fixed deposit of that's there with another bank, and that becomes available as a security. So this can really open up a lot of opportunities here. And here again we talk of the concept of credit identity. So the need to build strong awareness of the need for people to build a credit identity is really lacking still in the country. I think in a number of markets, and many of us know this, in a market like the US, even a student will start using a credit card, not because they need a credit card, but because they just want to build up their credit identity. They want to build up that fact that, look, they know how to responsibly use credit. They know how important it is to repay on time. They know the impact that this has on their score. And as they then evolve to buying a house and a vehicle and so on and so forth, they have a very mature score that's available for somebody to take a decision on. So awareness of credit identity is going to start becoming very important, and we have to create it as an industry and an ecosystem. And we spoke about context-specific lending. And of course, ongoing consumer engagement and digitizing that whole journey has a lot of opportunity. Recovery and repayment, I think, less answers and more questions here, because anytime when we look at increasing the penetration of credit. If we say, look, how do we take credit to the next 100 million? How do we expand the use of credit by people who already have it without over-leveraging this? Then one starts getting into recovery. So recovery means, I'm okay to give a certain line of credit of a certain value. So I'm okay to give, as a lender, is okay to give 2 lakhs, let's say, as a credit line, because the cost of recovery is worth collecting that amount of money. But how do I lend 10,000 rupees? How do I lend 20,000 rupees if my cost of recovery is still high? And the ability to recover is not fully digitized. So some tools are there. I think we've got things like autopay and so on, which are starting to get very popular. But I think it needs to evolve a lot more. A lot more sophistication needs to get built into this space that we are able to predict. We are able to predict a particular asset going bad. We are able to have an ongoing mechanism of scoring. So scoring is not just at point of origination, but scoring is an ongoing process by looking at the transaction flows. Red flags are picked up early in the cycle so that certain recovery or restructure actions can get taken well in advance. So all these are spaces that start really opening up and becoming available. I don't want to spend too much time on this, but these are all spaces where I think technologies like AI can play a very important role, going beyond the way we have thought about a digital journey and digital processes and a digital life cycle so far. So this is something that we at NPCI are kind of working on to really look at whether there is an opportunity to create a digital payment score that can become part of the credit scoring process. We'll be piloting this with a couple of lenders and then see how this really works out. But if you look at parameters, if you know that there is a user who is really paying all their bills on time, the flows around monthly payments of utility and all the standard things that somebody uses is very visible, then it indicates a certain profile of stability of that particular user. So even without really necessarily getting copies of their income tax returns, you start understanding the profile of this user. Similarly, a user that's on a reasonably frequent basis, probably making purchases of a high value, starts indicating somebody who's looking at aspirational needs and has the income stream to support it, and then that can cause a certain kind of a judgment to be made. So these are inputs that can start evolving through the process of how scoring works. So I think what this really opens up to say is that from a fintech standpoint, while, of course, lenders will have their role to play and will really be the primary drivers of how all of this plays out, and this is not like today's story. I think this is going to play out for a few years to come. The role that opens up for participants to really work here in each of these spaces of that life cycle we spoke about. And the more we can move the needle and balance risk, both the utilization risk, the credit risk, with eliminating the friction at each one of those points, will really start changing the game. So whether it is open source platforms, alternate data sources, decentralized collections, more sort of work on the bureau side, probably evolution of new kind of bureaus that will look at these new kind of scores. And yeah, of course, I think this convergence for us to really take the digital payment story and tie it up with that credit opportunity will lead us to a situation where we can formalize this credit economy, grow and scale the credit economy, and create more efficiency and growth for consumer business. So thank you very much.
Thank you. That was a wonderful session.